Howdy, everybody. Welcome to Liberty Call for Thursday, January 30th, 2025. Hope you're having a fantastical day out there in the interwebs. Kind of snowy here today. It's been overcast, a little bit of sun, but it's been kind of gray. We got about 2 inches of snow. People south of us got like a foot. So anyways. All right. Well, the central bank is cutting rates or central banks are cutting rates to brace for potential trade disruptions from Trump's proposed tariffs, while HSBC is shutting down M&A operations in the West to focus on Asia and the Middle East. In the markets, Progressive beat earnings expectations, sending shares higher, and India's Nifty index is hitting record open interest ahead of the upcoming budget. Meanwhile, UK businesses are struggling under tax and wage hikes, and many are facing financial distress. But before we break it all down, if you could do me a favor, give me some thumbs up, a like, share, subscribe, follow, and press that notification bell. All righty. Well, let's hop into the markets. Dow Jones was up 0.39%, 172 points, closed at 44,885. S&P 500 up 0.54%, 32 points, closed at 6071. NASDAQ up 0.25%, 49 points, closed at 19,681. The VIX was down 4.35% today. It's at 1584. Canada up 1.31%, Brazil up 2.66%, and Mexico up 1.16%. In Europe, Germany was up 0.43%, the UK up 1.04%, France up 0.88%, Netherlands up 1.55%, Spain up 1.08%, Italy up 0.16%, Switzerland up 0.62%, and Portugal up 0.07%. Russian exchanges both green again today. MOEX up 0.48%, RTSI up 0.49%. And the overnight markets, the Nikkei in Japan was up 0.03%, Australia up 0.55%, New Zealand down 0.44%. And all the overnight markets in Asia or China are closed today. All right. That speeds things up. Well, let's jump into our market recap, see what actually happened here domestically. S&P 500 rises, but Microsoft, Nvidia slump, keep gains in check. All righty. The S&P 500 managed to squeeze out some gains on Thursday, but Microsoft's rough earnings report kept things in check. It's been a wild week for big tech, especially after all the hype around China's DeepSeek AI model. Investors are now picking through earnings reports to see how these companies are really holding up. Microsoft's tanked 6%, even though its earnings beat estimates. The problem, cloud revenue and AI spending didn't impress, but Wedbush says Microsoft AI revenue was actually $1 billion ahead of expectations, meaning the AI boom is far from over. Meta climbed 2% after solid quarterly revenue, but the company warned that Q1 may not be as strong. Tesla bounced back 4%, promising cheaper EVs and lower costs. IBM surged 12%, hitting an all-time high thanks to booming AI demand. Nvidia slipped 3%, still feeling pressure from China's AI competition. Apple is up next. Investors are closely watching for updates on AI hardware sales and overall growth. Earnings misses. UPS and Caterpillar taking a hit. Caterpillar dropped 4%, missing Q4 revenue expectations and warning of lower 2025 sales as dealers cut back on inventory. UPS plunged 14% after weak revenue guidance for 2025 and news that it's slashing Amazon deliveries by more than 50%. Fed keeps rates steady as GDP growth slows. U.S. GDP grew at 2.3% in Q4, slower than 3.1% in Q3, a bit weaker than expected. The Federal Reserve held interest rates at 4.25% to 4.5%, staying cautious as inflation remains sticky. They're also keeping an eye on Trump's proposed tariffs and fiscal policies, which could shake things up even more. So while tech earnings are still driving the markets, all eyes are now on the Fed's next move and Trump's economic agenda. Buckle up. It's going to be interesting. All right. Let's get to our next bit of data. Fourth quarter GDP initial. This comes to us via Robert Stein at First Trust. So let's see what they had to say about this report. The U.S. economy grew at a 2.3% annual rate in the fourth quarter, slightly below expectations, but still above the 20-year average of 2.1%. While this suggests steady economic movement, the underlying details paint a more nuanced picture. Strong core GDP, but investment weakness. The best news, core real GDP, which excludes consumer spending, business investment, and home building, but excludes Volatile factors like government spending and trade rose at a healthy 3.2% annual rate in Q4 and was up 3% year over year. However, business fixed investment, which includes spending on equipment, commercial construction, and intellectual property, declined by 2.2%, the first drop since 2021. Even with the AI boom, companies appear hesitant to make large capital investments, which could hurt long-term productivity growth. A 4.2% jump in consumer spending fueled much of the GDP growth, but there's a catch. Americans are saving less. The personal savings rate fell to 4.1%, well below the pre-COVID average of 6.7%. If households start cutting back to rebuild savings, spending could slow, dragging down economic growth. Federal spending grew at a 3.2% in Q4 and 4% over the past year, but this level of government-driven growth isn't sustainable. Eventually, spending cuts or budget tightening could create temporary economic headwinds. On inflation, GDP rose 2.2% in Q4, still above the Fed's 2% target, with M2 money supply growing at a 4.9% annual rate. The Fed will remain cautious on rate cuts unless the economy weakens significantly. Unemployment claims dropped last week, signaling continued job growth, while the Richmond Fed Manufacturing Index improved slightly, though it remains negative. Bottom line, growth remains steady but fragile, and the Fed is unlikely to cut rates before spring unless the economy takes a sharp downturn. Wholeheartedly agree. We probably shouldn't have been cutting rates last year, but that's just my opinion. All right, from Zero Hedge, U.S. pending home sales plunged in December. This is a pretty short article. Pending home sales in the U.S. took a steep dive in December, dropping 5.5% from the previous month, far worse than the flat growth expected by economists. On a yearly basis, sales declined 2.9% instead of the anticipated 4.2% increase. This marks the first month-over-month drop since July and pushes the pending home sales index near record lows, making it the lowest December reading since data collection began in 2000. Affordability remains the key issue, according to Lawrence Yoon, the chief economist at the National Association of Realtors. Higher mortgage rates have significantly impacted home buying activity, particularly in expensive regions like the Northeast and the West. While weather conditions may have played a role, affordability remains the primary challenge for prospective buyers. Regionally, sales fell across all areas of the country. The West saw the biggest drop at 10.3%, followed by the Northeast at 8.1%, the Midwest at 4.9%, and the South at 2.7%. Given that pending home sales are a leading indicator of existing home sales, this downturn doesn't bode well for the housing market in early 2025, with 2024 already marking the weakest year for home sales since 1995. Affordability pressures could keep the market sluggish in the months ahead. All right, awesome news. And last up, just some commentary from Mr. Peter Schiff. This comes from Zero Hedge. It's titled "Peter Schiff, the Fed is Ignoring Key Data." I listened to his podcast this morning and figured this would be a good finish up for the broadcast today. All right. The Federal Reserve's decision to hold interest rates steady continues to stir debate, with economist Peter Schiff weighing in on its implications. He criticizes the Fed's reluctance to push back against inflationary policies, challenges the idea that the Fed is truly apolitical, and examines President Trump's evolving stance on oil prices and interest rate cuts. He clarifies Trump's recent comments on oil, noting that the former president tied potential Fed rate cuts to a significant drop in oil prices, something that hasn't happened yet. While oil has declined slightly, it remains around $72 to $73 per barrel, far from the drastic drop Trump envisioned as a catalyst for demanding immediate rate cuts. During the Fed's press conference, Chairman Jerome Powell dodged questions about tariffs and their inflationary impact, claiming that the Fed should remain neutral. Peter argues that true independence means being free to express opinion, especially when policies could harm the economy. He criticizes the Fed for failing to act as a check against inflationary risks and notes that monetary policy remains too loose, with borrowing still high despite rate hikes. Powell also stated that the Fed won't wait for inflation to hit 2% before cutting rates, a stance Peter sees as inconsistent given the Fed's past reluctance to cut when inflation was below the target. He also highlights Powell's vague response to questions about asset bubbles and Bitcoin, suggesting the Fed is more concerned about propping up asset prices than it admits. Peter concludes with Trump's renewed talk about eliminating income taxes, something he supports but believes should go further. He argues that removing all income taxes, including Social Security taxes, would be a much needed reform rather than just a political talking point. Wholeheartedly agree. All right. Well, we got through that pretty quick today. All right. Well, if anyone needs anything from me, please go to, wait for it, DSAFinancialGroup.com. All your financial planning needs can be addressed there. So give me a buzz. I'd be happy to help. All right. Well, I hope everyone has a wonderful evening, and I'll talk to everyone again next time. Adios.